A missile is fired somewhere in the Middle East. Within minutes, gold prices move. Not hours later, not after analysts issue reports, not after the evening news covers it. Minutes. No human being decided to buy gold in those minutes. No trader picked up a phone and placed an order. A set of automated systems monitoring geopolitical signals, measuring market volatility, calculating risk exposure in real time, executed a rebalancing. And the price moved. Most people see this and assume the market is emotional, reactive, irrational even. From the system's perspective, it is none of those things. It is functioning exactly as designed. The average person's experience of this goes something like this. They open a news app. There's a headline about conflict somewhere. They scroll past it. Later, they check their portfolio or see a financial headline. Gold hit a new high today. They feel the two things are connected but can't explain how. It feels instinctive, almost superstitious. Gold goes up when things get scary. Everyone knows that. But everyone knows that is not a mechanism. And without the mechanism, the pattern looks like coincidence. It isn't. To understand why gold and geopolitical stress are structurally connected, it helps to start with what gold actually is inside the financial system. Gold is not a productive asset. It doesn't generate earnings. It doesn't pay dividends or interest. A bar of gold sitting in a vault produces nothing. What it does is persist. Gold cannot be printed. It cannot be created by a government decision or a central bank policy. Its supply grows slowly, roughly 1 to 2% per year through mining, and that rate is essentially fixed by geology, not by human choice. This makes gold fundamentally different from every major currency in the world. Every major currency, the dollar, the euro, the yen, is what economists call a fiat currency. Its value is backed by the credibility of the issuing government and its central bank. When a government needs to respond to a crisis, a war, a recession, a pandemic, one of its tools is expanding the money supply. More currency enters circulation. Each existing unit represents a slightly smaller claim on the total pool of value. This is not a flaw in the system. It is a design feature. It gives governments flexibility to respond to shocks. But it also means the value of any fiat currency is, at its foundation, a function of institutional trust. Gold doesn't require that trust. This is not a philosophical statement. It is a structural one. And it is the reason gold functions as what the financial system calls a non-dollar store of value. Now, here is where the mechanism connects to the headline. When a missile is fired, when a conflict escalates, the financial system does not react to the event itself. It reacts to what the event signals about risk. Specifically, two kinds of risk. The first is inflation risk. Military conflict, particularly conflict involving major oil-producing regions, raises the probability of supply disruptions. Supply disruptions drive energy prices higher. Energy prices feed into the cost of almost everything else. When inflation expectations rise, the real value of cash and cash-equivalent assets falls. The system rebalances away from assets whose value erodes with inflation and toward assets whose supply cannot be expanded by policy. Gold is the clearest example of that category in existence. The second is counterparty risk. Every financial asset, a stock, a bond, a currency, involves a counterparty, a company that could fail, a government that could default, an institution that could freeze access. Under normal conditions, counterparty risk is priced and managed. Under geopolitical stress, counterparty risk becomes harder to model. The range of possible outcomes widens. The system's confidence in its probability estimates decreases. Gold has no counterparty. It does not depend on a government's continued solvency, a bank's continued operation, or a payment system's continued access. It simply exists. In a world where the reliability of institutional counterparties becomes uncertain, an asset with no counterparty becomes structurally more valuable. These two dynamics, inflation risk and counterparty risk, activate simultaneously when conflict escalates, and they activate inside automated systems before most humans have finished reading the headline. Here is what that looks like at the institutional level. Large asset managers, pension funds, sovereign wealth funds, insurance funds operate under mandates that define acceptable levels of risk. Those mandates are enforced by algorithms, not by daily human decisions. When a geopolitical trigger crosses a defined threshold, a strike on critical infrastructure, a conflict involving a major oil-producing nation, a significant escalation in a region the system classifies as high risk, risk models automatically flag the need to rebalance. The instruction is not buy gold because things are scary. The instruction is reduce exposure to assets with elevated counterparty and inflation risk and increase allocation to assets that historically maintain value under these conditions. Gold is one of a small number of assets that satisfies both criteria simultaneously. At scale, thousands of institutional systems executing this rebalancing in the same window produces a price move. The move is not driven by fear in the emotional sense. It is driven by simultaneous mathematical recalculation across an enormous number of portfolios. The retail investor who buys gold because it feels safe is, without knowing it, participating in the same structural dynamic as the institutional system. The reasoning is less precise. The outcome is the same. This is where the mismatch between human intuition and system design becomes visible. People tend to think of gold's price movement as a sentiment indicator, a measure of how scared the market is. And there is some truth to that at the surface level, but framing it purely as sentiment misses the structural layer underneath. The system is not scared. The system does not experience fear. What the system does is continuously calculate the probability distribution of future outcomes and allocate capital accordingly. When that distribution shifts, when the range of negative scenarios widens, the math changes. And when the math changes at institutional scale, prices move. Gold's correlation with geopolitical stress is not a psychological quirk of markets. It is a mechanical consequence of what gold is and what geopolitical stress does to risk calculations inside institutional portfolio systems. The trade-offs embedded in this design are worth naming clearly. The system that makes gold a reliable hedge during crises is the same system that makes gold relatively unrewarding during stable markets. Because gold produces nothing, holding it during calm markets means foregoing the returns generated by productive assets. The hedge has a cost. That cost is the opportunity foregone while the hedge sits idle. For the institutional perspective, this trade-off is acceptable. A small, persistent allocation to gold is a form of insurance. The premium paid is the return not earned. The benefit received is stability during the specific conditions where other assets are most likely to lose value. For the broader financial system, gold's existence as a non-dollar store of value also functions as a continuous, real-time referendum on institutional trust. When gold rises sharply, the system is signaling that its confidence in fiat-denominated assets has declined. It is not an accusation, it is a calculation.